Hello everybody, welcome to this new episode of Chat GP Tax. We're here with David. David, would you introduce yourself and tell us what you do on a day-to-day basis?
Absolutely, thank you for having me. My name is David. I'm with Howden. Howden is a tax broker. I focus on tax insurance within the team with a specific focus on the Benelux. We broke all types of different risks, but I focus specifically on tax insurance on the Benelux market.
Thanks a lot. I think this is a very interesting topic. Tax insurance has greatly evolved over the last couple of years and is even more significant with the tightening of the tax positions everywhere on the planet, also from a tax compliance perspective. Can you tell us more about what is the today's landscape of those tax insurances?
Yeah, absolutely. So the product itself is there to ensure identified tax risks that are quantified on which advice is available. We started in an M&A context. In the DD process, you have a tax issue that comes up. Can we insure it, yes or no, under the WNI policy? Sometimes you can still do that. But out of that practice, we evolved to a separate product, which is tax insurance. Initially focused on M&A, now we see it in a whole variety of sectors. About 50% of the policies we place today are still focused on M&A, are still in the context of M&A. About 50% of them are no longer have anything to do with M&A. So the product, in that sense, has really evolved. Also, the types of risks we're insuring have evolved greatly as well. I mean, 5 years ago, 10 years ago, the things we were insuring then are completely not the same things we're insuring anymore today. Today, we're still, for example, already looking at transfer pricing that can be insured. More common things, like withholding taxes, capital gains on shares, etc., what have you. But the product has evolved greatly, not only in the type of risks we can insure, but also the conditions and the pricing that is applicable to the policy.
And you can also have a tax coverage for litigation procedures as well, for existing litigation. That's something that I find it very interesting, so that if the risk has already materialized, you still have the possibility to cover it with an insurance. I guess the conditions will be different, but it's also something that we need to keep in mind.
No, absolutely. That's something that used to be not possible at all. Today we can do that. We have done it in the past, also for Luxembourg. Obviously, every risk is different. We have to really see at the merits of each case, but it is something that can be done. In terms of premium, you're looking at higher premiums, obviously, because the risk has already been identified. But yes, that's definitely possible today as well.
And how do you see the Luxembourg market in terms of insurance? Because we were discussing before, people know it exists, but I still have the impression that it's not yet totally everywhere, that people do not necessarily have the reflex to go for an insurance when they have a risk.
Yeah, no, that's true. The product is still a relatively new product. It originated in the US 10, 15 years ago, then came to the UK where Howden is based. Now we're seeing it the past 5 years or so in continental Europe. Luxembourg is an important market for us because obviously there's a lot of decision makers, a lot of funds and private equity firms that are here. So we see it as a very important market and a growing market, but it's true that it is not a mature market yet. I think the main thing is that it's just word of mouth really. A lot of people don't know about the product yet, or they have experience from the past which were too expensive or it's not possible, they gotta know. That has changed. So through that word of mouth, we do see more and more people relying on tax insurance. Some private equity firms we work with, for example, see it almost as a standard now to have tax insurance in place, just like WNI was now is as well. So we see evolvement, but there's still a lot of work to do, and that's, for example, why I'm here to try to achieve that goal.
Well, there is some sort of demystification of the product and better knowledge about the product as well that needs to come through this type of discussion that we're having right now.
Absolutely.
But I guess as the product democratized and is more, say, accessible, have you seen a change in the people you were in touch with, also because of the nature of the type of product you are insuring? It's not only M&A. Have you slowly transited from deal teams to more GP or IFM person, or?
Absolutely, we see that shift in different jurisdictions. We see that shift happening more already than in other jurisdictions. Like I said, Luxembourg is a relatively young market, but we do see that. Our biggest clientele these days are the funds and private equity scene. We're trying to expand that more to financial institutions, to big corporates. So we do see that is happening, but it's a process, and we have to take into account the specificities of each jurisdiction.
And and I think it's really important to mention, how or when can it be useful for the private equity sector? And I think people need to keep that in mind, obviously, when they're facing certain risks.
Well, the real answer is there's no risk that we would not look at to see whether we can insure it or not. Asking the question to the market is an effort for us, is an effort for the advisor, but it's really free of charge. So we can go out and ask the question, where do I see it being relevant for the market here? I mean, we can cover the whole life cycle of your investment, from acquisition, financing, and withholding tax or other issues that relate to that, to those things, up to the exit. For example, in the fund industry, something we're doing now as well is looking at residual, before winding up a fund, looking at residual risks and whether or not these can be insured so that their investors can receive their investment back quicker. So the product really is evolving, and we see through the whole life cycle, we see that we can try to achieve that.
That's interesting, because this was one of the points we were discussing before we started recording. It's basically at the end of the fund when you need it, and I think your experience.
It costs a lot to maintain a fund open, just for I may have an exposure to tax for deals that potentially didn't. Were not covered by a tax insurance.
Exactly.
So how do you approach those things where deals are exited, for instance, the fund comes to the end, there is no maybe one or two escrows left, right? And so, but they want to be able to be in a position to liquidate the fund as soon as possible. Is that something that you have already faced?
That's something that we've placed before. It depends. So a product that we can use is tax insurance, right? Mm-hmm. For that, really, we have to have identified risks on which advice is available, which is not always, an ideal context in the scenario that you're describing. A different similar product is fund wind-up insurance, which is basically a sort of WNI-ish insurance, where the insurer does a mini DD of the residual risks that are available or that are existing in the company, wraps insurance around that. We cover the running costs of the structure and the running costs of the premium and the insurance, and everything else can be distributed up to the investors. So that's something that has been insured and has been done in the past.
That's really interesting.
Okay. In terms of, you said Luxembourg is a new market. So what would be a mature market? Where do you see people more contacting you? Which jurisdictions have more appetite for this type of insurance these days?
It changes over time. Looking in the past, obviously the US and the UK, where we're predominantly active, that's a huge market for us. But we've seen also a large expansion in Spain, for example. It was one of our biggest markets in the past. The emphasis changes. Some tax administrations become more active on specific risks than sometimes others. But yeah, for example, in Europe, Spain definitely, the Netherlands is getting bigger as well. We have now somebody covering Germany. I focus on the Benelux, which I think still has a lot of potential as well. Even, for example, Italy, which was a jurisdiction that was hard to insure a few years ago, is a jurisdiction now that we cover regularly.
And I think what people also want to know is, what are the terms and conditions that you typically have in a policy in terms of risk you can cover, description, maturity of the risk, the pricing, etc. So can you give a brief overview of this?
Yeah, sure. So I would say the core of the policy is really the description of the risk. That's where the advisors come in together with us and the advisors of the insurer to really make sure that we have an umbrella cover, wording, to cover all the type of attack routes that the tax administration can use. That's a core part of the policy. Another important part are the exclusions, because obviously we want to know what is not covered. There's a couple of standard exclusions, for example, fraud, misrepresentation. Also change of law, which is important to note. It's only change in black letter law that is not covered. Those are standard exclusions, and then depending on the type of risk, you'll also have potentially specific exclusions to the risk. Just thinking out loud, we've done a policy recently where we have a partial demerger, where we demerge the real estate from the operational business, and then a potential on sale of the real estate company with whether or not there's anti-abuse that could lie in the sale of the shares. There, for example, a specific exclusion could be the fact that you cannot sell that demerged company for a certain period of time. So that really depends on the type of risk that you're covering. So that's an important one. Also important, especially for the insurer, but we get a lot of questions about that as well from the insured, is the conduct rules. Okay, what happens if we get audited? What happens if we get a claim? What can we do? What can't we do? How does the communication work between us as the insured, the broker, and the insurance company? So that's a whole different language that you'll find in there as well. And then obviously pricing. Tax policies, in principle, you have a one-time premium payable after the policy has incepted, typically 20 business days. How much that premium is depends on the risk, of course. For an average risk in the Luxembourg market that has been seen before, I would say these days probably around 1.5 to 2.5% can be achieved, which is a huge improvement compared to a few years ago where we had rates online, so premium percentages of 10% or even higher. So the market has changed a lot in that respect as well.
Absolutely. It was very interesting how things have evolved very fast, actually, and how this market is developing. And I guess it's very important for GP to be aware of those conditions and that the product can help them not to incur costs, to have bigger and faster DPI to investors, limit the IRR, and also consumption of time of people within the GP to keep on running funds or deals in a different fashion compared to what they were doing before.
No, absolutely. And I mean, that's the beauty about the product, right? You know how much it's going to cost in advance. You know what you're covering.
And it's flexible.
It's flexible and it works. We also have numbers on claims. And based on those numbers, on our experience, we see that the product works. We have had even full limit payments that have been made in the past. So it is something that works as well. So yeah, I agree with you.
And just maybe one last question before we close this session. How does it really work when you have an audit or the risk materializes? How does the whole indemnification process works?
Yeah. So we at Howden, we have a separate claims team. What happens is if you get your audit, and also the policy will describe this, you have to notify the insurer of the risk materializing. We ask to do that through us as well, so we can assist you with that specifically. That's called the notification of the claim, and then the process starts. The insurer will look at, does this fall within the framework that we have agreed? If that's the case, you as an insured, really, you continue working as if you were not insured. It's even a requirement to act as if you're not insured, right? So you still are facing the tax administration. You're still providing the answers, doing the discussions, but you have those insurer on the side who will obviously want to be a part of that and who will want to be informed and assist with key decisions. For example, you shouldn't settle without the insurer being in favor of that. But that's really how the process works. And then if the risk has crystallized in the end, and that can be in different ways, either the risk goes away, tax administration agrees with you, or the courts have been exhausted, or you come to a settlement, then you'll have what is called under the policy a final determination. And that's the moment that your payment will be made. Policies do provide advanced tax payments, so you can get advances on your final payment. The wording depends from insurer to insurer and from jurisdiction to jurisdictions, but sometimes it can happen, especially if there's a legal obligation to pay a disputed tax, that you can already get advances before that final decision has been made.
Very interesting. Thank you very much for coming and sharing all of this with us and with our audience. And to our audience, stay tuned.